The investment world is vast, offering an array of vehicles designed to meet a wide range of financial objectives. Among these, real estate investment trusts, or REITs, stand out as a unique blend of real estate and stock market investments, presenting a compelling option for income-seeking and diversification-focused investors. But despite their growing popularity, REITs are not without risks. This article explores the genesis of REITs, the reasons for their existence, the allure they hold for investors, and the potential hazards that come with investing in them. The origins of REITs, a path to democratic access. The REIT structure was born out of a legislative desire to democratize real estate investing. Created in the United States in 1960, REITs were designed to provide individual investors with an opportunity to own shares in large-scale, income-producing real estate assets. Prior to introducing REITs, direct ownership of commercial real estate was the exclusive domain of institutional investors, corporations, and wealthy individuals. By forming a REIT, these commercial property holders could now offer ownership shares to the public through stock exchanges. Essentially, the creators devised REITs to function similarly to mutual funds. Whereas mutual funds allow for diversified ownership of stocks and bonds, REITs enable ownership of real estate, whether it be office buildings, shopping centers, hospitals, or even data centers. This breakthrough allowed everyday investors to tap into the commercial real estate market without requiring vast amounts of capital or management expertise. But the REIT structure didn't just offer access to real estate. It also provided liquidity, something sorely lacking in traditional real estate investing. Historically, real estate has been an illiquid asset class. Selling a property or securing a return on investment often took months or even years. REITs solved this problem by making real estate shares tradable on public stock exchanges, offering a level of liquidity unheard of in direct real estate ownership. Why do people invest in REITs? Given their unique structure, REITs provide a range of benefits that have made them an attractive investment option, particularly in recent decades. 1. Income and dividends. A reliable stream of cash flow. For income-focused investors, REITs are a natural draw. By law, REITs are required to distribute at least 90% of their taxable income to shareholders as dividends. This results in consistent dividend payments, often at yields higher than traditional equities. Given the low interest rate environment that has prevailed over much of the past decade, these dividends have become appealing to retirees and other investors seeking regular income. Diversification is a cardinal rule of investing, and REITs offer a powerful avenue for achieving this. Traditional portfolios composed of stocks and bonds often lack exposure to real estate, a sector with its own unique economic drivers. By incorporating REITs, investors can achieve better risk-adjusted returns. Real estate behaves differently from equities or bonds. Factors like occupancy rates, local economic growth, and property management, rather than the broader market forces that govern stock prices, influence property values and rental income. One of the lesser discussed but crucial advantages of REITs is their role as an inflation hedge. Real estate typically appreciates in value. As inflation rises, so too do rents and property values. This makes REITs an attractive option for investors looking to preserve the purchasing power of their income in an inflationary environment. Given the recent surge in inflationary pressures globally, this attribute has gained renewed attention among savvy investors. Perhaps the most significant benefit REITs offer is liquidity. Historically, real estate investments required long holding periods and significant capital outlay. REITs offer the ability to buy and sell shares as easily as trading stocks. This liquidity allows investors to adjust their exposure to the real estate sector without being tied to the long-term obligations of property ownership. The different REITs. It's important to understand that REITs are not monolithic. They come in various forms, each with its own risk profile and return potential. Broadly speaking, there are three primary types of REITs. 1. Equity REITs. Equity REITs are the most common form of REIT. They own and operate income-generating real estate properties, collecting rental income from tenants. Most equity REITs focus on a specific type of real estate, be it residential, commercial, or industrial, offering investors an opportunity to choose the sector they believe has the most growth potential. 2. Mortgage REITs, or REITs. Mortgage REITs do not invest directly in properties, but in the mortgages and loans used to finance them. These REITs earn income from the interest on the loans. While mortgage REITs can offer higher yields, they are often more sensitive to interest rate fluctuations, which makes them riskier than their equity counterparts. Hybrid REITs, as the name suggests, combine elements of both equity and mortgage REITs, owning both properties and mortgages. While they offer some diversification within the REIT structure itself, they also inherit the risks associated with both types. While REITs offer attractive benefits, they are not without risks. It is critical for investors to understand the potential downsides of investing in this asset class. One of the most significant risks associated with REITs is their sensitivity to interest rates. As REITs distribute most of their income to shareholders, they often rely on debt to finance their property acquisitions. When interest rates rise, the cost of borrowing increases, which can reduce the profitability of these investments. Higher interest rates make the yields on bonds and savings accounts more attractive, drawing capital away from dividend-paying investments like REITs. Although REITs provide liquidity by being publicly traded, they are still subject to the same market volatility as other stocks. The prices of REIT shares can fluctuate wildly based on investor sentiment, broader market conditions, and economic forecasts, even when the underlying real estate assets remain relatively stable. Like all asset classes, REITs can become overvalued, especially during periods of low interest rates when investors flock to high-yielding alternatives. As the demand for REIT shares rises, their prices increase, which can cause yield compression, where dividend yields fall as share prices rise. This makes it important for investors to assess the underlying value of the real estate assets held by a REIT and not simply chase dividends. Management and operational risks. The quality of the management team overseeing the properties heavily influences the performance of REITs. Poor management decisions, such as overpaying for acquisitions, failing to maintain properties, or mismanaging tenants, can have a substantial impact on profitability. In addition, some REITs charge high management fees, which can eat into returns. Should you invest in REITs? Whether REITs deserve a place in your portfolio depends on your investment objectives and risk tolerance. For income-oriented investors seeking regular cash flow, REITs can be a valuable addition. They offer a convenient way to gain exposure to real estate without the headaches of property management. However, they may not be suitable for investors seeking high-growth opportunities or those particularly sensitive to interest rate movements. The sector-specific nature of many REITs requires investors to have a solid understanding of the underlying real estate market and its dynamics. A balanced approach to REITs. In a world where diversification is paramount, REITs offer a compelling opportunity to gain exposure to the real estate sector in a liquid and accessible manner. Their appeal lies in their ability to generate steady income, offer protection against inflation, and diversify traditional equity and bond portfolios. Yet, like all investments, REITs are not without their risks. Investors should weigh factors, such as interest rate sensitivity, market volatility, and operational risks. While REITs can provide solid returns, they require due diligence and a clear understanding of their place within a broader investment strategy. In the end, REITs can be a powerful tool for investors, but they are not a one-size-fits-all solution. Investors must weigh the benefits against the risks and ensure that their REIT investments align with their broader financial goals. Hit that subscribe button and the notification bell to stay informed.